The true cost of tariffs is almost impossible to quantify. But if a retailer didn't or couldn't absorb the costs and passed it all on, how much would prices increase? Well, Alex Partners built these example models exclusively for us to illustrate it. So before the April 2nd tariffs, a cotton men's sweater made in China cost $6.80 to produce. Pre-Liberation Day, a 41.5% total tariff was already in place for that sweater shipped to the U.S. That equals $2.82. The cost of logistics and sourcing, that adds another 95 cents. So put together, the total cost of making that sweater is $10.57. At a typical initial markup rate to get to a 65% gross margin, the retail price before Liberation Day for that sweater would have been $30. So here's the same sweater at today's tariff rates. The China manufacturing costs, logistics and sourcing costs, those are constant in this example. But at the 41.5% existing tariff for that sweater before April 2nd, and then the 10% universal rate, 20% fentanyl tariff, the current tariff rate is 71.5% of the manufacturing cost, or $4.86, making the new cost the retailer pays to make that sweater $12.61. So holding that 65% markup to maintain that level of profitability and a new price the consumer would pay, $35.80. So that's a price increase of more than 19%.
That's only if you pass the entire cost on.
If you pass the entire cost on right now at where we're sitting today.
Right.
So let's look what happens if the full tariffs announced April 2nd would be enforced. At that 41.5% pre-April 2nd existing tariff for that sweater, plus the additional 145%, the tariff rate is 186.5% for the sweater, or a tariff cost of $12.68, making the new cost the retailer pays to make this sweater $20.43. So if you use that same 65% markup to maintain the level of profitability, the new price a consumer pays $57.97.